Let's talk about how you invest around what we're seeing right now. Given what's going on in the CPI, given some of the uncertainties about inflation, and for that matter, geopolitics, how do you make investment decisions in this climate?
So I think you still have to stick with the longer term trajectory, kind of where you see the most opportunities longer term. I think that there is still a real case to be made for switching from the kind of new economy back to the old economy. Areas like industrials, energy, financials, a lot of these areas still have very, very good valuations. I think on the more growthy side of the market, I think you want to be more selective. So we obviously saw things like communication services. A lot of the tech companies really rallied pretty fiercely over the last couple days. I think you still want to be careful there. So we like tech, we like things like software, we like things like semis, which look pretty washed out on earnings sentiment, but we'd be a little bit more cautious with some of the internet-related names.
But to draw a football analogy, that sounds like running off tackle 3 yards instead of throwing a long ball. That you're not really betting on a lot of big growth in the near term.
I think so. I think so. And what we see when we look at different economic forecasts is the price we're likely to pay for a short, shallow recession is subpar economic growth that follows. So think of something like 0.5%, 1%. That is an environment in which valuation will matter.
So David, what do you think of that? I mean, is this a time to really dial it back some? What are you interested in as an investment opportunity?
Well, toward the latter parts of this week, we've gotten more defensively positioned. I do think that we have a small recession next year, and I do believe it hits profits. Profits would be flat at best, probably down 5%. I think Lori's down a little bit more than that in her estimate. So the S&P's at 18, 19 times forward earnings. And, even though it's just, in our view, a short and shallow recession ahead, I think there's going to be more frequent recessions than we've been accustomed to in the past 20, 30 years during the 2020s, and also inflation a little bit more sticky. I love these clips. The 1994, after that midterm election, I mean, that's when Clinton pivoted, and it's also when the Republicans had strong messaging and policy suggestions, and a long period of economic growth and declining inflation for that decade and 25 years after that. So I'm just not sure we saw the signs of that happening today.
So what stocks do you like, David? What should we be looking?
I focus on industries, and then my portfolio managers pick the stocks in their various strategies. I'm most overweight healthcare, both big biotech and pharmaceuticals, and big banks. Then we're dabbling in a few other areas like aerospace and defense and oil services, where we're overweight. But we're also underweight a lot of things that we think are going to be weighed on by the goods and the manufacturing recession that we see ahead. Materials, much of industrials. We're still cautious on semiconductors. And everything consumer discretionary, auto, retailing of both brick and mortar, and even internet retailing.
Lori, how does that match up with you? For example, semiconductors. Do you have a different view on semiconductors?
So I think with semiconductors, what we're seeing is that basically nobody's taking earnings estimates up right now. And historically, when nobody's taking earnings revisions up or earnings estimates up, it's usually pretty good 12-month forward signal in the market. Now, it doesn't mean they're going to turn around today. We have seen some of the price action improve there a bit lately, but it's really a longer-term kind of contrarian type call. I would say, though, I think Dave and I are mostly on the same page on a lot of stuff. We like the banks. I think we both still like small caps at this point in time. And, I'm probably, a little more cautious on the defensive areas of the market. I think things like staples and utilities still very expensive. You've had some room left in healthcare valuations, but that's starting to creep up as well. So you're
not as enthusiastic about healthcare as maybe David is.
I'm still overweight, but I'm getting a little concerned about it. I mean, frankly, just because coming into this reporting season, we were getting close to peak valuation on that sector as well, and now we've knocked it down a peg or two. That there were some rough earnings with this sector, but I think we have to tread cautiously on the defensives. I like small caps, I like banks, because they are typically areas that do well coming out of a recession. You've got really cheap valuations. In the case of small caps, we've got a bucket of work showing that they're pricing in a recession already. In financials, I think it's more of an earnings resiliency thesis, more of a domestic play. But I think it's probably time, in my estimation, to start looking for some of those recovery trades.
To what extent have the projections of earnings taken into account inflation? Because that really is a margin pressure issue, isn't it?
Well, so what our modeling has shown on inflation, that if you sort of think about how they play into an earnings model, for example, I see positive correlations with revenues. So the inflationary backdrop has really been goosing revenues in S&P 500 companies. We find that when inflation comes down, it doesn't really help margins all that much, but bringing inflation down is going to pull revenues down. Wages are actually, kind of the more important factor within margins. So one of the reasons why we've been so cautious on earnings next year as as a whole is because we are baking in that moderation in inflation. It's going to pull the revenues down. It's not going to help the margins as much. But I do think a lot of people who cover stocks don't understand the revenue dynamic and don't appreciate that the impact on margins isn't going to be as big as they think.
Where are you on earnings going forward? What are you projecting?
My estimate for next year is 220, and I expect this year to finish up at about 223, 224, thanks to energy.
So you're down, but just a little bit.
Down slightly. The average recession, but we're expecting smaller than average, causes a 15 to 20% decline in profits. But usually more than half of that decline in profits is from financials and energy. Energy is smaller than it's been in the past, although it's growing every day. And we think banks will be fine because we're not expecting credit costs to surge.
Well, aren't banks really benefiting from increased rates?
They are. They are.
That simply?
And it's been one of the bigger areas that we've seen in terms of upward revisions. And so when you think about why the earnings estimates haven't collapsed as much as we might have otherwise expected at the broader level, it's financials, it's also energy. Until recently, you've actually seen net positive revisions in energy.
Are you concerned at all, David, about possible cracks in the system overall? We've seen some, certainly saw it in the UK with the pension plans.
Sure.
And there's some rumblings back in the United States. Are you worried about that?
Well, I can't say that I've been able to point out a systemic risk that's really keeping me up at night. Frankly, I'm more concerned about geopolitical issues.
FTX is not a systemic risk?
I don't think so. No.
What do you make of that?
I make it out of just too much speculation. And I don't think it's systemic, but I do think it is something that has stung and will continue to sting many people involved with that. Now's not a great time to be speculative, and the dollar, at least from for Americans, the dollar is doing just fine. And I wouldn't be too enthusiastic about finding alternatives right now.
Have you been interested in cryptocurrency at all, Lori?
I try to avoid it at all costs. But
Why?
Well, look, I think that I think David and I both lived through a lot of these cycles, and it just. I'll tell you what I sensed this time around, very different from the dot-com bubble, but there was a lot of skepticism in our community about crypto. I find that, you had sort of certain pockets of the hedge fund community that were true believers, but I think most of the people that I talked to have been pretty skeptical, didn't really understand necessarily what the point of it was, kind of solving a problem that didn't exist. And I think, I've always sort of believed when you don't understand it, you want to avoid it.